Let's talk about your local bank, not the giant faceless one with branches everywhere, but the community bank right down the street. Well, a huge shift is happening right now at the Federal Reserve that's totally rewriting the rules for thousands of these banks. And, it could change how business gets done on Main Street. For years, this has been the big question, right? Are the incredibly complex regulations made for Wall Street giants actually choking the life out of the small town lenders that, fuel our local economies? It's a classic problem, a one size fits all rule that just doesn't fit. So the Federal Reserve's main job is to keep the entire financial system safe. But think about it. The risks a multi-trillion-dollar international bank faces are just worlds away from a local bank that's mainly funding small businesses and home loans. Making them both follow the same heavy rulebook, it creates a massive and pretty unfair burden. Now, here's what makes this whole story so interesting. It's who is leading the charge. Federal Reserve Vice Chair Michelle Bowman isn't just some regulator in an ivory tower. She's actually been a community banker. She holds the first ever seat on the board that's specifically for someone with that background. So she brings this real-world perspective to the table that's just invaluable. She's been in their shoes. So what's the big solution? Well, it's this idea called regulatory tailoring. And this isn't about making the rules weaker, not at all. It's about making them smarter, more flexible, and honestly, more appropriate for the specific bank we're talking about. It's a huge move away from that rigid one-size-fits-all system. At its heart, tailoring is really simple. The rules should match the risk. It means the Fed actually looks at a bank's business model, its size, how complex it is, and then applies rules that make sense for that bank, instead of just handing them the same 1,000-page manual meant for some global giant. And this analogy just nails it. A community bank is like your family car. It's reliable, it's essential for getting through your day, and it needs solid standard safety rules. But a global bank? Oh, that's a Formula One race car. It's an incredibly complex, high-performance machine that needs a completely different, way more specialized set of safety rules. You just can't regulate them the same way. And Vice Chair Bowman said it herself, this is an active mission. The whole point is to right-size the regulations to match the actual limited risk these community banks have, freeing them up from having to deal with rules for problems they'll never even face. Okay, so how does this new way of thinking actually turn into action? Let's get to the good stuff, the specific changes that are real game changers for these banks. We're going to focus on two things, making it easier for them to grow and giving them more flexibility with their money. First up, growth. For a lot of healthy community banks, merging with another small bank is a key way to grow and serve their community better. So the Fed is working to streamline this whole process, cutting the red tape so that good strategic mergers can actually happen without getting lost in a sea of paperwork. Second, and believe me, this is a big one, is the capital rules. Think of capital as a bank's financial safety cushion. The community bank leverage ratio, or CBLR, is a really important measure of that cushion. By giving well-run banks more flexibility here, the Fed is letting them use more of their money for what they do best, lending it right back into their communities. But let's be absolutely crystal clear about one thing. More flexibility does not mean lower standards. This isn't about making the system riskier. It's about making supervision smarter and more efficient. The fundamental rules of keeping banks safe and sound are not changing one bit. In fact, get this. Even with these new, more flexible rules, the amount of that safety cushion, that capital, that community banks have to hold onto is still nearly double the international minimum standard. So the key takeaway here is that our system's safety net is still incredibly strong. Okay, so beyond just changing the rules, there's an even deeper shift happening here. It's a change in the whole philosophy of how bank checkups are done, moving away from just a simple box-ticking exercise toward really looking at what could go wrong in the real world. And to make it all official, the Fed has published this new set of supervisory operating principles. Basically, it's a new directive for every single bank examiner out there, telling them to focus on what actually matters for a bank's long-term health, not just tiny procedural details. This slide really shows you the powerful mindset shift. The old way was all about ticking boxes. Are your policies written down right? Did everyone show up to the meeting? But the new way? It asks much smarter questions. What are the top 3 things that could cause this bank to fail? And, more importantly, do you have a plan to survive them? And this quote from Vice Chair Bowman just captures it perfectly. It's about shifting from being just an auditor to being a real risk analyst. The goal is supervision that actually means something, that helps protect a bank and its customers from whatever might be coming around the corner. So, after all this talk about ratios and regulations, let's bring it all back home. Why does any of this matter to you and me? Because at the end of the day, these changes are designed to be felt directly in your own community. I mean, think about it. When a community bank isn't drowning in paperwork that was really designed for a Wall Street firm, it has way more time and resources for its real mission. That means more loans for the new restaurant on Main Street, more mortgages for young families buying their first home, and a stronger financial lifeline for rural and underserved areas. Ultimately, the goal here is refreshingly simple. Just clear the path for community banks to focus on what they do best, understanding their local economy and serving the financial needs of their neighbors. It's about letting bankers be bankers again. So this new, tailored, risk-focused approach is a landmark change, no doubt about it. But in a financial world that's always changing, it kind of leaves us with the big question for the future. Is this smarter playbook going to be enough to make sure that vital, relationship-based local banking can not only survive, but actually thrive?